Doug, I want to go to your belief in a caution in the markets with the volatility that we have. Is it certain we see weaker markets, or can earnings and revenue growth in the American economic machine push the market to stability or even higher?
Well, 2017 was a year of hope and anticipation, I think in large measure because of the optimism surrounding the tax reduction. S&P price-earnings ratios expanded by almost 3 multiple points that year. Interest rates were suppressed and volatility was at historic lows. But this year, markets are more or less unchanged, and we have the reality of instability and inconsistency of policy, and economic uncertainty has reemerged. This year, unlike last year, Main Street has thrived and Wall Street has stagnated. I think we have a new regime of volatility emerging, coincident with the general rise in rates, particularly in maturities of 10 years or less.
Doug, you've enjoyed the international economic crises that Michael Spence and Dominic Constant have studied with us here in New York. All of a sudden, the rationalization catches up with the equity market. Describe for our audience how we rationalize EM instability and how one day the U.S. stock market ends up with a headache.
Well, rates, the instability, the causality to me is interest rates. And yesterday afternoon, we had the highest Treasury yields since 2008 in 3 months, 6 months, 1 year, 2 year, and 3 year. And in the 5 year, the highest rates since 2009, 10 years, highest rates since 2011. And I have a memo to everyone that thinks that the recent interest rate rise is inconsequential from an historic point of view. People saying 3.1 is not meaningful in the 10-year. Why is the rate rise dangerous? It's very simple. When we assess the impact of a rate rise, we should observe debt service as a product of two independent variables, the amount of debt and the interest rate imposed on that debt. And so that observation that the rise is inconsequential is wrong, given the mountain load of record private and public debt outstanding compared to any time in history. And then we have the issue of, the world being, let's say, network, as Dr. Spence would say, flat, networked, and interconnected. And I'm concerned that the administration's hastily crafted strategy, tweeted out inconsistently, is beginning to have a negative impact on the real economy in terms of derailing and deferring of business fixed investment plans. And I think the president, to paraphrase Vizzini in The Princess Bride, has fallen victim to one of the classic blunders, the most famous of which is never get involved in the trade war in Asia. But only slightly less well known is this: never go against North Korea when nuclear weapons are on the line.